So you would think, well, that means Bitcoin's going to peak in the first quarter of 2026.
Yep.
Not so fast, because what happens is Bitcoin lags by about 3 months, by about 10 to 12 weeks. So now Bitcoin's going to lag that. So if all things being equal, we don't have a market shock, which takes everything that I'm talking and
throws out the window.
Right out the thing. Yeah, exactly. But if we don't have a market shock and we just keep doing what we're doing through the end of this year, then I think that Bitcoin's going to peak out somewhere in the first quarter of next year to, half, like the first quarter, the first half of next year, it's going to peak out. I think we're going to be 150, 180 by the end of this year. I don't know where the top is. I'm not the guy who says it's going to be $1 million this year, but I don't know. It's Bitcoin.
You might be wrong.
I might be wrong.
Bitcoin could soar to between $150,000 and $180,000 by the end of this year, with a potential peak arriving in early 2026. That's the forecast from James Lavish, chartered financial analyst and managing partner of the Bitcoin Opportunity Fund. Every 4 years, the halving cuts Bitcoin's supply in half, and this scarcity often ignites the next major price surge. However, the big move usually doesn't happen immediately. Lavish explains that the real upside typically emerges a few months later, once the market adjusts to the reduced supply and demand starts to build. If current trends continue and no major macro shocks intervene, he expects Bitcoin to reach between $150,000 and $180,000 by year's end. Still, Lavish cautions that sentiment can change rapidly, and once momentum shifts into euphoria, price targets can quickly be surpassed. Stick around until the end of the video as James Lavish shares his latest Bitcoin outlook and explains how high the price could climb if current trends hold.
When you talked about the issues of institutional adoption then, are those issues now no longer relevant? Do you think that kind of red tape has been removed?
It has with the ETFs. One fell swoop. It was so fast. That's the operational issue. Because, when you're an institutional investor, you've got fiduciary responsibility, and then you've got like this personal risk as well when you're doing this stuff, which is professional risk. So you've got to perform your duty, and you can kind of hide behind that sometimes if you don't want to take on this professional risk. What do I mean by that? I mean, if you're going to buy Bitcoin, real Bitcoin, and you're gonna have your key phrase, who's gonna take control of that wallet, that signing device? Is it going to be you? Are you going to do it with a chief investment officer? Or are you going to have your legal counsel involved? I mean, that's just the first thing.
This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to portfolio, tap your Solana asset, then click close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
Yeah.
How is that really going to work? And that's actually what people think about first. But when you're sitting in those meetings, that's kind of down the line. First of all, it's like, what is this thing? Where does it trade?
Am I willing to take career risk?
Well, yeah, because that's first. Like, even if you think you love it, even if you're an investor and portfolio manager who understands it, gets it, and loves it, wants to invest in it, the problem is, where are you going to trade it? Coinbase, Kraken, like, what are these things? Back then, 2021, yeah, Coinbase was there, but institutional wise, it was, we don't really know. Then you had FTX happen and everything. So it was really sketchy. And so that was just a big hurdle to get over. And then who holds it? Like, you don't custody normally. So what these institutions love is they love having custody taken care of for them. The highest rating in debt is AAA. That's prime, right? And so the US was always, it's the global reserve asset, right? The US Treasury. And
you surely can't get better debt.
Surely you can't get better debt. Like, this is riskless. Like, this is supposedly the 10-year US Treasury is supposed to be riskless.
Yeah. That's
the point. Well, then we had a couple of things happen, and one of them was a budget battle. I believe it was S&P that downgraded them first, if I remember correctly. And
Just S&P obviously is not the actual S&P. That's
No.
Standard
Standard & Poor's. It's Standard
Yeah.
& Poor's. It's the same company. It's just
Okay.
that this is a different, area, different division.
This is that, yeah.
So they downgraded not because they think that the U.S. is going to default and not pay the bonds. So this is where people get a little bit tripped up. AAA is like, there's no risk whatsoever that you're ever going to default, right? Then you've got AA, which is, it's like as close to AAA as you can be, obviously, but there's something there. Okay, so why would they downgrade the U.S. if they're never going to default, really? And even when they did default because of this budget battle, it was back in, I want to go back and, I've got the newsletter here, so I don't want to quote the wrong time frame, but it was, 1979 is when they technically defaulted. So what happened? So they were in this budget battle, and back in 1979, everything was done by paper, right? So they're in this battle, and the congressmen are going back and forth. They're fighting about it. They didn't want to raise the debt ceiling. Finally, they get to a solution and they raise it, but it was at like the midnight hour, and it didn't give the Treasury enough time to stamp the envelopes and get them out the door with their interest payments. And so they tripped a payment, and they made it up really quickly. They made everybody whole, but technically they defaulted. So that's what we're talking about here. Because, Lynn talks about all the time is like, if you're a sovereign that issues debt in your own currency, you would never default. You'll just print more currency and buy the debt to make sure that you're not defaulting.
Yeah.
And so, but the technical default is that you trip a payment and then you make everybody whole later, which is what happened in 79. Back in 2011, it's the same kind of thing happened. That's when S&P, so it was Fitch who did it first, and S&P did it.
Did what?
No, I'm sorry. S&P had downgraded the U.S. first.
In 2011, after the financial crisis.
And yes, in 2011. Then 2023 is when Fitch joined them.
Okay.
Yeah. But why does that matter? And why do you see that? So you see bond investors get worried about this. And how do you know that they're worried? Well, you see term premium. You see premiums that meaning that the debt trades at a higher yield than it normally would. Because you can calculate it out. The term premiums are somewhere around 80 basis points or 90 basis points right now for the 10-year. It should be higher, but we'll get to that in a second. But the reason that you have that is because investors are concerned about inflation. And just this deluge of debt, who's going to buy all of it, which means that they want to be compensated for that deluge of debt that's coming. We're seeing that people are a little bit worried about inflation, which gets us to stagflation. We can talk about that in a minute, but the people are concerned about that. Investors are concerned about that. And bond investors are like, they don't want to buy 10-year, 20-year, 30-year treasuries and have what happened back in 2022 all over again, where, interest rates go up, the bond is worth less, and they're sitting on this portfolio of marks that are, down 20, 30% again.
Yeah.
So how do they compensate themselves and protect themselves? Well, they demand a higher rate. And this is where the bond vigilantes come in. Bond vigilantes are the ones who are saying, no way. And it's not like a group of, just that investors are looking around. Yeah, they're looking around. They're saying, yeah, we need a higher rate here.
Yeah.
And they're not colluding, but they're recognizing each other like, yeah, I need a higher rate too.
Everyone's seeing the same thing.
Right. So then you get this term premium. And the last piece of that, so you've got inflation, worry about interest rate risk, concern of interest rate risk because of, both inflation and because of the deluge of debt that we know is coming. I love Doge. It's great that they're getting rid of fat and fraud, but they're not going to balance the budget.
Of course,
it's just not going to happen.
That seems more clear than ever right now.
You're right. I mean, I've been saying this for since the start. It's like it's too much. The math is not going to work. So, but that's fine. The issue here is that the last part of that is now you've got this deeply divided political faction, right? So you've got the Democrats and the Republicans they almost can't even they can't even speak. Like it used to be back in the 80s at least, and the 90s, they could at least talk
Yeah.
across the aisle and really, kind of be reasonable. Totally
That's out the window.
irrational. Like they're totally unreasonable between the two parties now. So that means that each party is trying to trick the other one into making cuts into their programs to hurt their constituents to get fewer votes. We know that. It's the way it works. But the issue here is that they're so entrenched in the battle that the risk is that we go right up against that window again, it closes and we trip a payment. Of course they'll make it up, and they will make everybody whole and they won't fully default. It'll be a technical default. Then why do the credit default swaps on the US bonds start to get more expensive?
Institutional resistance to Bitcoin is finally starting to crumble. With ETFs now approved, larger pools of capital are flowing into Bitcoin where hesitation once prevailed. At the same time, confidence in US debt is weakening. Credit downgrades, political gridlock, and rising yields are pushing investors to question what was once considered safe territory. Amid this uncertainty, Bitcoin is gaining momentum. Assets defined by scarcity are increasingly seen as stable alternatives when traditional systems falter. The global dependence on the dollar is showing signs of strain, accelerating the search for new options. As liquidity shifts and markets recalibrate, Bitcoin's role continues to expand. If these trends persist, many expect a strong breakout by 2026.
It's all of that stuff. And one of some of the factors that go into that are not just the amount of bonds that are out there or whatever, but it's the amount of collateral that is needed to borrow. And so when you have volatility in the markets, the increase in volatility means that you have an increase in margin. Why is that? Because when you have a really big increase in volatility, it's usually because you're seeing drawdowns. And so you have the banks and the prime brokers raise the minimum collateral, which is called the haircut. So if you're going to go buy a stock, you're going to go buy an Apple or Microsoft and blue chip S&P stock. You would typically have to put down 6% for that, and you would get portfolio margining on the rest of it. You could borrow 94% against it. But then in times of shock or times in high volatility, that 6% might move up to 20, 25%, which we saw in the great financial crisis, even in blue chip stocks. And so that means that you need more liquidity. You need more collateral for that borrowing, which brings down the borrowing because you're obviously going to sell part of your position to get enough collateral to secure that position with your lender. And so that draws liquidity out of the market. So when you see high volatility, that's not good, especially in bonds, because bonds are the base asset to borrow against in repo markets and shadow banking repo markets, not just with the Fed. And so that's bad. When you see the MOVE index get higher, that's bad for liquidity.
About this. Yeah.
Yeah. So, and that's the issue, right? And so, I think Jack and I have talked about it. So that's the issue, and that's part of the calculation. Okay, so this goes back to your question, what do I think is going to happen with Bitcoin this year? Well, I still think that we're expanding liquidity, and you can see it. You've seen liquidity expanding recently. And so, and Michael's studies have shown that liquidity goes in 5 to 6 year cycles. The last cycle bottomed out, and it's going to be 5 years coming at the end of this year, I believe. So his point is that liquidity is going to peak at sometime in the first quarter of 2026.
Bitcoin briefly touched nearly $112,000 in late May, and analysts are now watching for a potential breakout above $115,000 in the weeks leading up to July. This outlook depends heavily on two key factors: rising institutional demand and the upcoming U.S. jobs data. If the labor market shows signs of cooling, it could accelerate expectations for rate cuts, weaken the dollar, and give Bitcoin the momentum it needs. However, if the data is stronger than expected, a short-term pullback toward $120,000 or even down to the $95,000 accumulation zone remains possible. Despite short-term fluctuations, Bitcoin continues to follow long-term liquidity cycles, multi-year capital flow patterns that have influenced every major move in the past. James Lavish expects this expansion phase to continue, with Bitcoin likely building toward its next high in 2026. At the same time, ETFs are steadily eroding institutional resistance, as billions in new capital flow in, supported by improved custody solutions and infrastructure that were not available in previous cycles. This transformation is helping Bitcoin evolve from a speculative asset into a more mature global investment. The market is shifting, and with it, Bitcoin's role within the financial system is changing. As conditions improve and infrastructure strengthens, Bitcoin's influence and adoption are set to grow even further. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.